My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain you, but to educate and teach you about how these crazy days work. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Turns out Nvidia's mortal after all. Even though it reported a great quarter last night, it wasn't able to deliver its key product fast enough to allow the company to do what it's done so many times before, blow away the earnings. Yeah, raise its forecast to unfathomable levels. Nvidia didn't define today's trading because it failed to dazzle in the way that so many money managers had come to expect. Didn't even seem to matter to the averages, though. Dow advancing 244 points, S&P basically flat, NASDAQ dipping just 0.23%. My response to all this, all I can say is, goodness gracious. With this quarter's results, the albatross of perfection is now gone. The millstone shredded. As much as I love Nvidia, I'm thrilled that we can finally return to a market where there are many important stocks representing many important trends instead of one stock that's captured the attention of legions of investors, many of whom have no idea what it does, let alone where it fits into the technological food chain. I stand by view that you should own the stock of Nvidia and not trade it. After all, I've spent days warning you that the buy-side expectations were too high and the stock had run way too much going into the quarter. I told you the company needed to deliver a gargantuan beat and raise quarter in order to make it rally, something that seemed very unlikely, if not downright impossible. But I never backed away from my belief in the value, the ultimate value of the company. What I'm saying is that in the end, Nvidia isn't a concept. It's not a cult. It's not a miracle. It's a company that designs really fast chips that allow for rapid calculations that help companies speed up the solving of problems while improving productivity. You can't ask NVIDIA's Blackwell chip to cure cancer. Can't do that. It won't put a man on Mars. It certainly can't bring about world peace. Yet when you look at how this stock was trading in recent weeks, the market was basically asking CEO Jensen Huang to do all of these things and more. Instead, right now, it looks like it can expand customer gross margins. Important, but not earth-shaking, especially because the enterprise is the client, not you. You won't even see it. Now that this quarter's in the rearview mirror, my hope is that those who wagered on the stock, notice the word wagered as opposed to invested in the company, will finally move on. No more exacta box with AMD to place, please. We have to go back to a world where we try to value Nvidia like any other company. We have to put a reasonable price to earnings multiple, PE multiple on it, given its growth rate. Wall Street analysts are saying Nvidia can earn $5 per share in 2026, which I think is a reasonable time frame when you're evaluating a big growth stock. We have to figure out what it should be worth based on that dollar number. Given that Nvidia is growing much faster than the average company, it deserves to trade at a premium to the benchmark S&P 500, right? You with me? That currently sells for roughly 24 times this year's numbers. Since we're using the 2026 estimates from Nvidia, the results at a little more of a discount. So let's say 24 times $5 of future earnings per share. What does that give you? $120. It's just a few bucks above where it's currently trading. It's trading like the average stock. Now, I can easily argue that Nvidia deserves to trade at a premium to the average stock of the S&P since it grows much faster than the average stock, and it's a much better company. So let's give it twice the P to E, twice the price to earnings multiple of the S&P. That would put it at $240. Again, whoa, it's not the average company. That seems pretty high, though. So let's split the difference and say that it deserves to trade at 36 times the 2026 estimate. That takes us to $180, but more than $60 above where it's trading. But realistic. I'm going through this entire exercise of boredom because after this quarter, I'm hoping Nvidia becomes just another company, maybe even a boring one. One that's valued based on earnings rather than intangibles. And this is how we value a typical high-quality growth stock, which it is. I just gave you the process behind where a stock trades, all stocks. Now, all stocks, including Nvidia. It is a tedious process, this valuing of a stock. But in the end, that's what Nvidia is. It's a stock. Doesn't matter how brilliant Jensen Huang might be. I call him Da Vinci, but it doesn't matter. He's the CEO of a public company, not a magician or an alchemist or an artist. Now, I'm thrilled that Nvidia brought a whole new set of enthusiasts into the stock market, but I'm bummed that so many of these people are more gamblers than investors. They only got in because the valuations went from $500 billion to $3 trillion in 18 months. Therefore, they desperately needed that progression to continue. They were unrealistic, and I sense they now go and be unrealistic, betting on games of sports or chance. DraftKings, here we come. You know what? As Thomas Paine mold, they were always sunshine soldiers. They were always summer patriots and soldiers. I am disappointed. I'm disappointed in these people because I want them to stay. But I sense from the action at the end of the day, they're gone. Summer soldiers. I think this situation makes room for something great, though. I want to turn it into, as we'll talk about later in the show, lemonade. Let's turn the lemons into lemonade. See, we can focus now on all the terrific companies that were lost in the Nvidia shuffle. For example, how about AMD, which also makes chips, including chips for that, while not quite as useful for artificial intelligence NVIDIAs, are still basically in the same league. Plus, AMD makes chips for traditional computing and servers that compete against a hobbled Intel. AMD stock is actually very cheap on its 2026 earnings estimates versus stocks, or the others in the S&P. Oh, and by the way, what happened to NVIDIA was actually good, not bad for AMD. They are a competitor, for heaven's sakes. How about a company like Apple, which is about to issue a new phone that will soon be offering the latest in artificial intelligence for the consumer? The stock's historically pricey, but historically, Apple didn't have a service revenue stream that's sticky and predictable and creates a whole new level of stable earnings. Plus, Apple will be using ChatGPT, which has cost OpenAI and Microsoft billions of dollars to build, yet these guys are getting it for free because Apple's such a huge, highly valued installed base. Hey, how about Amazon? Stock down 29% off its high, like 29 points, not percent, 29 points. Even as we've just seen some surprisingly strong numbers from a series of major retailers, Best Buy this very morning, Walmart and Target. The consumer's clearly doing fine as long as you give her good value. And that's Amazon's middle name. Plus, they've got the best beat on how to use AI to figure out your buying patterns and batch your orders for same-day delivery, something that only costs Costco and Walmart. They're the only ones that can possibly beat them when it comes to price, but not delivery. Maybe Walmart Plus and delivery. On a company like Salesforce, how about this? Salesforce, they reported last night, they know how to use a generative AI to create smart agents that can answer pedestrian questions. Very important because pedestrian questions are about 90% of what customer service reps need to handle. Agentforce, the new AI initiative, will allow for massive expansion of gross margins as bots are a lot cheaper than people. We'll learn more at the company's annual Dreamforce Festival in 3 weeks. Again, not a barn burner. But that's the point of artificial intelligence. AI doesn't burn barns. It simply imitates us, which can be pretty valuable if you run a business. That stock should have been up, not down today, because the use cases were so compelling. I don't know what happened. It was a mistake to me. So I say goodbye to the Nvidia watch parties. Let's go back to the days when Jensen Huang was seen as a brilliant engineer with a black leather jacket and lots of amazing ideas, not an otherworldly miracle worker. Nvidia is not the hope for the future of mankind. It's a company that's very, very good at what it does. It's leading the AI revolution, which doesn't cure cancer or even the common cold, but does help businesses do things quicker and for less money than ever thought possible. Bottom line, Nvidia is not sexy, not Legion, not Superman, just an excellent computer company led by a CEO who's one of the best at what he does. Just remember, though, even with Nvidia, it's not personal. It's strictly business. Let's go to Sam in Pennsylvania, please. Sam.
Jim, listen, after listening to Nike's fourth quarter earnings call, I got to tell you, we got a bigger issue than just the issues that we're talking about with the consumer. It's quality control. You see, I've been buying Nike my whole life. I'm a runner. I ran in college. What I've been noticing is that the shorts are just falling apart. And until they fix this issue, I think it's going to act as an overhang stock. So I need Nike to understand that the quality of the products matter to us consumers.
Wow. Okay, so I was talking to Mary Dillon at Foot Locker. Foot Locker had a good quarter. She still swears by Nike, swears by the Jordan, swears by all that. But I get the same feedback you do, which is why I've been emphasizing emphasizing Hoka. If New Balance were a public company, I've been emphasizing that. I agree that there are real big issues with Nike, bigger than we can ever handle in this 2-minute call. But they have to be resolved if that stock is going to go higher. All right, now that National NVIDIA Day is finally over, they know nothing! I think we all should remember that even with NVIDIA, it's not personal, it's strictly business. On Mad Money tonight, Crowdstrike reported its first quarter since the cyber glitch took down millions of computers worldwide, and I'm seeing where things stand with the CEO. Then some people are having a hard time picturing the applications of generative AI. I'm listing all these important use cases and how to invest in them. And Gap shares were hauled earlier in a nutty thing after the company's second quarter results were accidentally released early. But the stock still finished the day higher. I'm hearing what Wall Street liked in the report when I sit down with the company's top brass, and I'm liking that company's stores. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Oh, it's been a crazy couple of months for Cramer fave Crowdstrike, the cybersecurity company that made headlines for all the wrong reasons back on July 19th, when a botched update caused widespread tech issues, shutting down millions of systems around the globe. There was a ton of speculation that these outages could hurt their business. But last night, Crowdstrike reported a strong sales number, excellent earnings beat, terrific customer retention. As a result, the stock jumped nearly 3% today. It was up a lot more at one point. While it's still down over 30% from last month's all-time high, it's also rebounded 35% off its recent lows, where I said it had bottomed. So could this thing have more room to run? Let's check in with George Kurtz. He's the co-founder and CEO of Crowdstrike to get a better sense of the quarter. Mr. Kurtz, welcome back to Mad Money.
Great to be here, Jim.
Oh, so George, when you called me that morning, that Friday morning, and said, "Listen, this is what's occurred," no holds barred. You came clean, told everything, textbook way to handle this. I thought for sure that you would lose or a lot of customers, or perhaps that it would freeze the process and all the big deals you were working on wouldn't come to fruition. It was the exact opposite, wasn't it, George?
Well, Jim, obviously it's a challenging time for customers and for Crowdstrike. And really what we wanted to do was to be as transparent as we could. That's when you and I talked about the incident. We worked with our customers. We explained what happened. And it was a tough quarter, but we got big deals done at the end. And I think what we're seeing from customers is the positive response to how we responded to this particular incident. Big challenge. But obviously, we've had many customers for many years that we've created loyalty with. And I think it's a sign of a true partnership if we can work through them through difficult times.
But you put me in the room. Tell me what it was like. I understand that you tried to call the CEOs instantly, you personally, and get to work on this. That it was not one of these things where you basically said, listen, let's call some of these people that are big. No, it was everybody who was important to you, and that you did it personally, and then you put your team on it. Was that the way it went down?
It was. Obviously, we have a great team, and, it was a bit of divide and conquer. But I was on the phone, obviously, all morning. And really, I continue to be on the line over the last 6 weeks. And it was calling everyone from government agencies to CEOs to everyone else in between. And, that's always been a philosophy of mine, is making sure that we get in front of the customer. We do right by them. Obviously, we had an impact and we had an issue. We wanted to make sure that we own that issue. And more importantly, we're focused on getting them back to recovery and doing that in the most expeditious way that we possibly could.
There seems to be one that I thought was going to be common parlance that turned out to be an outlier, and that was Delta. Now, Delta which is suing you, they made it feel like did you not try to reach out to senior management at Delta? Because it sure seems like you kind of dropped the ball this one.
It's an unfortunate incident. Obviously, we caused an impact, and we tried to work through it with them. They've expressed it from a legal perspective. They may intend to sue. They haven't decided at this point. But look, we'd love to work with Delta, find a resolution around this. And at the end of the day, we're trying to work with all customers to make sure that we address their issues, they understood what happened, and we can go forward in a constructive fashion. And that would be our goal.
Okay, I think that's the correct response. One thing that did concern me is that there were some people who were basically kind of mischaracterizing what happened here, including people in your industry who don't seem to realize that this could happen to anybody. I don't know how anyone in business didn't understand that, because this was not core competence that was in question. Tell me about what people aren't getting right.
Well, when we look at what happened here, Jim, it was a configuration change that was made to software that was tested and running for the better part of 5 months. And we encountered a bug. It went through a validation process, and obviously we had an impact. And when we think about the industry we're in IT, and I spoke to many customers who talked about many vendors that had impacts and issues. And, it happens in IT. This obviously was something that was visible, and it happened to a lot of customers. But, from our perspective, we've identified what it was. It was a process issue. Obviously, there was a bug in the validation process. We've corrected that. And more importantly, we're focused on making sure that we have the best process around QA, rollout, deployment, and resiliency. And we really want to be a hallmark of transparency and resiliency in this area. And that's really what we've talked to customers about, giving them control, giving them assurance it won't happen again, and moving forward. And that's been well received by our customers.
And it clearly worked. I mean, when you're part of the conference call, it's really a clinic that you put on that kind of had this beautiful arc where you finished with you had a couple of, you had a nine-figure, an eight-figure, and then you finished with a major player in your own industry that clearly endorsed you. But then there were talk about customer commitment packages. Now, this is a term that I'm not familiar with. It sounded like to me rebates or discounts, and that made me be concerned that perhaps not everything is as well as I thought it was.
Well, Jim, from my perspective, always try to do right by the customer. All right, we had an incident here. We want to sit down with customers, want to have a business conversation. What can we do to help make things right? And the customer commitment package is really a framework around that, where we're leveraging our flex licensing model to basically create a pool of dollars where we can work with customers, perhaps give them some modules, maybe extend some timeout, also provide things like services. So we want a framework to be able to sit down, solve business problems, and make sure that we're coming to the table proactively with them to show our commitment and partnership.
I was joking with David Faber about how when they say that you worked around the clock, that you meant it. And David said, yeah, sure. But there is another sidelight to you that I don't mean to, we're having a serious conversation about what went wrong, but there is a sidelight to you that you race cars. You race cars where it seems like you never have to sleep. So round the clock for you is not the same as everybody else. Is that not true?
Well, everything is endurance, right? And whether it's in business or in racing, it's all about endurance. It's about the small little details. It's about putting the team together. It's about focusing on, the outcomes. And we took all of that preparation, we put it into action with our crisis management team. And we worked around the clock. And so did a lot of our customers. And that's what collectively we needed to do. But we focused on working with them hand in hand and bringing them back to health in both automated ways and in many ways manual ways. But we were out there with them and with our partners solving the issue at hand.
And I just want to go back to Dell to be sure I got this right. So you're in talks, no actual papers filed, anything. It could be anything, because obviously when you talk about law, it could be anything. But this is not something you're treating this as this can be ameliorated.
Well, I think that's it, Jim. If folks can sit down, have a business conversation around this, and try to come to a resolution. Obviously, we're open to that. Delta's a customer, and like any customer, you want to try to get this resolved in the most expeditious way. And we're certainly willing and open to do that.
Well, Drew, I tell you, of course, you never wanted what happened to happen, but I think we will look back at the way you handled this. They'll study it in business school. We'll study it as people in journalism to say this is the way you come back from a terrible mistake. That's why it was so good you came on the show. George Kurtz, founder and CEO of Crowdstrike. George, thank you for being so forthcoming about this whole thing.
Thank you so much, Jim.
Excellent. Mad Money's back after the break. Like I said at the top of the show, it finally happened. Nvidia disappointed. Well, not exactly. They blew away the analyst estimates, but the size of their upside surprise is decreasing. That and the delay of the new iteration of chips disappointed the traders, causing them to sell the stock today. It's still up 137% for the year, but it's not as good as it was yesterday. Now, all kinds of people are coming out of the woodwork, and they're not just knocking Nvidia, but they're claiming that the whole AI theme is kaput. Of course, that's not how I see it. All things considered, Nvidia reported a really good quarter, one that was strong enough to keep the stock from nosediving despite the sky-high expectations. I've been telling you all week that money managers were expecting this company to deliver yet another insane beat-and-raise quarter. But given the super high whisper numbers, the ones that really they were expecting from behind the scenes, portfolio managers were quietly hoping for these, and the fact that the whole industry seemed to be treating this quarter as make or break for the entire market, I think in the end it was probably a decent outcome. Nvidia got dinged, but there wasn't much collateral damage to the other AI plays. As we told CNBC Investing Club members last night, I think you should wait for some of the hot money to come out of Nvidia before looking to buy the stock on a pullback. But I certainly didn't hear anything about the thesis changing last night. In other words, there is a thesis and it's AI. There was nothing that makes me want to change my stance that you should simply own Nvidia, not trade it. So many people traded it, obviously, that, well, look how much money was lost. That said, I feel compelled to address something that's been bubbling under the surface for months now. This recurrent idea that artificial intelligence is kind of a sham with no real use cases. Some people still can't seem to envision what businesses can accomplish with generative AI or accelerated computing. Those are the two trends that Jensen Huang continually cites. They've seen how much money Nvidia and other AI-related hardware plays are making from selling the necessary infrastructure. We saw good numbers tonight from Dell, from Marvell Tech. Same deal. They've heard from the so-called hyperscalers like Amazon, Microsoft, Alphabet, and Meta. All of them have talked about investing tens of billions of dollars in AI infrastructure. They might have even used some generative AI applications like OpenAI, ChatGPT. That's theirs. Google's Gemini, Anthropic's Claude. I like that one. Meta AI, which is from Meta, and I think it's very cool and somewhat ironic and funny, too. But for most people, it's still hard to get your head around why all these big companies are spending fortunes on artificial intelligence. It almost seems fatuous. No matter how much fun you have with ChatGPT, it seems insane for any of the tech titans to spend tens of billions of dollars on something like that, right? In particular, lots of folks have been asking if anyone's seeing any actual return on investment. AI investment. Has anybody's gross margins been boosted by this? In fairness to the skeptics, the most compelling AI use cases have been slow to develop. Much of the early investment here goes toward training. That's the key word, training AI models. It's only after that process comes to fruition that you get artificial intelligence that can use inference to actually do something for users. Just as important, most of the areas where AI is truly useful are enterprise-oriented. As a consumer, you never know how effectively these models can write code. Keep that word, you've got to keep the word enterprise in your head because that means it's not you. That's why tonight I'm going to start something new. I'm going to keep a running list of some of the best AI use cases we've heard about. Now, some of these have already been out there for a while, starting with the big generative AI platforms. There's a free version of ChatGPT, but OpenAI makes revenue from $20 a month for ChatGPT Plus subscriptions, as well as higher price offerings for enterprise customers. There's that word again. Higher tiered Gemini and Claude offerings cost roughly the same amount. Plus, Microsoft's Copilot functionality and Adobe's Firefly tools have been part of their broader product suite since late last year. Those are both moneymakers. But now that we're starting to see more compelling uses of AI popping up, I want to walk through the ones we heard from just last night from both Salesforce and Nvidia. Last night, we heard Salesforce CEO Mark Benioff on the show, and he told us about how his Agentforce AI platform is starting to gain traction. Agentforce helps companies create fully autonomous AI sales and service agents. On last night's show, and really kind of exciting thing to tell you the truth, Benioff talked about some of the companies that have already deployed Agentforce and seen meaningful results. That includes the number one payroll processor, that's ADP, the restaurant reservation platform OpenTable, subsidiary of Booking Holdings, very successful company. But Mark's most compelling examples were Wyndham Hotel and Resorts, this largest chain, and Wiley. That's that college textbook company, because these companies are able to use Agentforce to handle seasonal demand trends that in the past would force them to do a lot of seasonal surge hiring. Very expensive. Bad for gross margins. They don't have to do that anymore with Agentforce. But here's how Benioff put it.
Let me give you another great example with Wiley, the textbook company, who's also using Agentforce. They have incredible seasonal demand right now when kids are going back to school. And they're able to use Agentforce to directly expand their customer service capability. And instead of hiring or trying to surge their customer service organization and train all these folks, which, by the way, is what they've done in the past, now they're able to just use Agentforce to take that additional capacity.
What a great explanation of what of what I think is something we're going to be talking a lot about when we get out to Dreamforce September 17th. Now, how about the use cases Nvidia mentioned on last night's conference call? These are companies that are all using AI and are already seeing results right now. So here's some software vendors: Amdocs, ServiceNow. We know they've got a really good product. It's a partnership with Nvidia. SAP, that's a giant company that helps coordinate technology at the enterprise. Cohesity, Snowflake, we've had them on a bit. There's an electronics manufacturer, Wistron, and an IT consultant, Accenture, another aggregator of concepts that goes to companies to help them figure out how to integrate tech. Nvidia also called out, quote, every automaker developing autonomous vehicle technology. By the way, that's a big deal because they've only been a couple of automakers before this. Plus, NVIDIA's inference microservices called NIM, which allow customers to run AI models on NVIDIA's high-end chips, are being used by Lowe's, Uber, and Saudi Aramco. That's the largest oil company in the world. AT&T apparently realized 70% cost savings and experienced an 8 times latency reduction by making it slower. This speeds it up by using this platform. Now, CFO Colette Kress went through all these examples of the call. We're talking about AI-powered chatbots, which is also, by the way, the agent power that Mark Benioff's talking about, generative AI co-pilots and agents that help build new applications and enhance employee productivity. For example, Amdocs used NVIDIA's technology to reduce customer service costs by 30%. Very impressive. Wistron, that electronics manufacturer I mentioned, is using NVIDIA's AI Omniverse to better plan out their factories. You make changes in the Omniverse to test what will happen in the real world, helping them reduce end-to-end cycle times by 50% and cut back a lot of waste. That's that digital twin thing I've talked about. The automakers love AI because autonomous driving requires massive amounts of computing power and learning potential. One more example. Last week, Amazon CEO Andy Jassy put up a post on LinkedIn where he noted that the company's in-house generative AI assistant for software development, Amazon Q, can help software engineers by doing the most tedious but most important tasks, like updating foundational software. Specifically with Amazon's in-house generative AI assistant, software developers can take a project that usually takes about 50 developer days and get it done in a few hours. Now, there's something that's I think is tangible. Apparently, Amazon has already saved the equivalent of 4,500 developer years, not hours, years worth of work. Jassy also says that the upgrades done with Amazon Q have, and I quote, enhanced security and reduced infrastructure costs, providing an estimated $260 million in annualized efficiency gains. Bingo. Bottom line, the next time you hear someone ask what AI is actually being used for, you can tell them that big established companies are already seeing huge cost savings from deploying this technology in part of their business. And believe me, when I say this is just the beginning of what I expect to be a very, very long list, pay attention. This is not chimerical. This stuff is real. Let's go to Zach in Minnesota. Zach.
Hey, Mr. Jim, it's so good to be with you again.
And I am glad that you're on the show. How can I help?
Well, listen, I know how hot under the collar you are that Ford will not start a buyback program, but I read that based on the Ford family's unique stock ownership structure, the only way they will ever return value to shareholders is through the regular and special dividends. This reminds me of a phrase you've used in the past, which is getting paid to wait. Now, when you were on campus in Miami, you said Ford was a company that you liked long term. And regarding the share price, you said, I can take the pain, can you? Now, Ford has an excellent yield, but by closing your position in the travel trust and advising us to stay away, are you suggesting that your philosophy of getting paid to wait does not apply this time? And if not, do you no longer believe that the company has a bright future? Thank you.
This is just a great question. And let me tell you what made me angry besides the fact that they didn't do the buyback. And the stock is the cheapest, one of the 5 cheapest stocks in the S&P. It's that they keep having problems making cars and making trucks. It's the warranty problems that kept me from embracing it any longer. It was too hard when I keep reading about the billions of dollars in mistakes, basically, that they're making. And I found that to be unacceptable. Listen, established companies like Amazon, Alphabet, and Meta are already seeing huge cost savings from deploying AI. And I think that list is only going to get longer from here. That means exploding gross margins. Much more Made Money, including my post-earnings exclusive with Gap. Jumping after earnings is the legacy apparel company showing signs of a turnaround. I'm hearing what the new Gap looks like with the CEO, and you know I think he's doing a good job. And few things in this business are more satisfying than outfoxing the short sellers. I'm sharing some of the names with you stocks that did just that. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. tonight after the close of the market, we were supposed to get results from Gap, which has been performing very well for the past year thanks to the leadership of new CEO Richard Dixon. This morning, someone inadvertently posted the numbers to the company's website, so we got the quarter a little early. And when you know it, Gap's done pretty darn well. It's all the more impressive when you consider that just a few years ago, Gap was in terrible shape. Now it's very much in turnaround mode, so can it keep climbing? Let's dig deeper with Richard Dixon, President and CEO of Gap. To learn more, Mr. Dixon, welcome back to Mad Money.
Jim, thank you so much for having me again.
Okay, so Richard, it's been a year and a week since you took over, and if you can give us your reflections from when you took over to now, we would love to hear it.
First of all, Jim, it's been a very exciting year, as you know, and certainly a successful quarter, and it's another successful quarter. We exceeded our expectations. Net sales up 5% growth, which is really, really solid, and it's on 5% less inventory. 500 basis points of gross margin expansion, and we also expanded our operating margin by 490 basis points. And you know that is a new narrative for Gap Inc. 6 consecutive quarters right now we've grown market share, and so it's really indicating that our customers are responding well to our brand reinvigoration efforts. We've been working very hard as a team to drive brand purpose, brand relevance, and drive revenue. And ultimately, the results that we're posting, another quarter of successful positive comps, is demonstrating that we're actually doing what we say we're going to do. And we're very confident as we continue to drive this strategy.
Well, let's take an important category for you, dresses. Now, there's something we can, something tangible about how you're doing.
Category growth is really important in the context of our strategy. You know, we've gained share in categories that are really important to the company. Denim, dresses, #1 dress business in the country right now with Old Navy. Also, #1 brand for kids and baby with Old Navy. So we feel really confident, particularly in women's. The team's been focusing on really reasserting Old Navy's style authority. The Gap brand has driven 7 consecutive quarters of growth in the women's category. The marketing that we're driving is really resonating. I know you're showing our new Get Loose campaign and our back to school campaigns with Gap. And those are the type of efforts that really drive relevance and revenue. And you're going to continue to see much more exciting work coming from our portfolio.
I can tell you're a man of the word. When you came in first, I said, well, Banana Republic looks dowdy. Well, you took me recently to a beautiful Banana Republic, which is stellar. I mean, and literally top to bottom. So tell me where that brand is, because I know that had flat numbers. That's not appealing to you, but it's going to be supercharged by what I just saw.
First of all, Jim, we really appreciated you taking the time to visit our new store in Soho. As you saw, that store is really the first full-forced expression of the new brand identity. And we're making progress with this brand. First of all, it's also a very important brand in our portfolio. It represents nearly $2 billion in sales. It's focused on the premium lifestyle space within our portfolio. We've been making adjustments on pricing, on assortment architecture. We've been implementing new merchandising strategies. As I shared with you very transparently, our men's business is in a stronger position right now than our women's. So we've got work to do. But I am very confident in this heritage brand that we could really unlock it for potential growth in the future.
Okay, tonight we had numbers from Lululemon. They frankly weren't that bad. But I know you said on your call that you're gaining confidence in a turn at Athleta. Now, I go to your stores at Athleta, and they're not, frankly, I just can't imagine you actually like the way they look now. But you have a vision of what could happen. Tell me some of it.
Well, look, I mean, we are very transparent in recognizing that we have work to do across our fleet in our store experiences. But to your point, I really am gaining more confidence in Athleta. Our team has been working so hard to reset this brand and set this brand up for sustainable growth. Net sales for the quarter were down 1%, but we are also lapping very heavy discounting from last year. And underneath the hood, there's really good progress being made. We successfully are broadening our customer base. We're seeing better sell-throughs at full price. Our new marketing is gaining traction. Our fashion product is resonating. So we're really starting to feel like the turn is upon us. And confidently, I can tell you, we now expect to see positive comps for the remainder of the year. This brand is one to watch. We're setting it up for sustainable growth in the long term. And you'll be, I think, very pleased with the progress.
How is that possible? Positive comps? Honestly, no, I'm not kidding. How's that possible?
Because we've been working hard. What do you think we're doing here, Jim? And we're driving.
No, I don't mean it like that. It's just that's so exciting if you can do that, because that just says in 1 year and a week, we have clear visibility for every single division. Flagship doing great. Old Navy's so important. I saw Banana Republic with my own eyes. I have to go back to look at Athleta. I'm missing something with Athleta, but you see it. So therefore, I must see it. Now, you use terms like you're talking about trend right. A lot of people are just talking about newness. Is there something beyond newness that you have to do?
Look, newness is incredibly important, no matter what brand you're operating, but it's particularly in the apparel space. Innovation is also a big part of the fashion quotient, if you will. We've been really well known for basics, really across our portfolio. We've been dialing up the fashion quotient. And it's really important to keep consumers engaged, to keep people interested. You have to be interesting.
Right.
And so we've been driving a lot of that idea through our brands. Design-led innovation is a really important part of our reinvigoration strategy. At the end of the day, product has to look, feel, and present with great value. And you can see it in our inventory. You can see it in our stores. You can see it online. Our brands are expressing new great storytelling through better product. And we're seeing those, results show up on the scoreboard. It's also really encouraging, I might mention this, that we've seen growth across all income cohorts, which means that we are really resonating. Our brands and our proposition is resonating with consumers. And we think, again, we're headed towards the right direction and unlocking the incredible value of this portfolio.
And back to school is good quickly, right? That obviously what you just said, back to school is doing very well.
We love back to school. I mean, first of all, marketing has been really strong.
Right.
Old Navy and Gap in particular. Yeah, it's been a good back to school, and we believe it's a great runway into the back half of the year.
Well, Richard, I have to tell you, you're a bit of a miracle worker. I wanted and have always cheered for your stores. You had 3 CEOs. I know they all did their best, but that wasn't good enough versus what you're doing. Richard Dixon, thank you for showing me around Banana. Thank you for fixing an icon. How about that? Richard Dixon, President and CEO of Gap Inc. So good to see you.
Thanks, Jim.
Dave Money's back after the break. It's time for the lightning round. Remember, that's where I could for quality saving the stock. I tell her buy, sell, just to go to the core stock today. Tell me, my share price is whatever someone buys. Play to sell. And then the lightning round is over. Are you ready, Skinny Dash? Over the lightning round. Let's start with Tad in North Carolina. Tad.
Hey, Jim. Thanks for taking my call this evening.
Of course. What's going on, Tad?
ADMA, ticker ADMA. Would love to hear your thoughts.
Okay, so this is a very speculative situation. It is up huge. I don't know whether I'm coming in at the right level, but I have to tell you, anytime there's immunity compromised patients, there's some big money down the road. Of course, it's horrible to talk money along with this, but I'd love to have them on the show. I think they sound like they have something breakthrough. Let's go to Fadi in Ohio. Fadi.
Mr. Cramer, thank you for taking my call, and thank you for your guidance and the lead in our U.S. economy.
You're very kind. You're very kind. How can I help?
I love your show, and God bless you and your associates.
Thank you. Thank you.
I'm a first-time caller, but a very long-time listener. My stock is about USA Rare Earth Mining, MP Materials Corp. MP.
I think this is one of those situations that's very difficult. They need to make a lot of money, and they have been trying, and this is special because we want rare earth to do well, but in the end, we have to have companies make money. And if they don't pull out of the tailspin of losses, then it just doesn't matter. And that's where I am right now in MP. It doesn't matter. Joseph in Florida. Joseph.
Hey, Jim. Booyah. Go Eagles.
Booyah. Go Birds.
Let's go. So I have a great question for you in regards to Dowcast Systems, stock ticker DCTH. I wanted to find out if it's time to invest, or should I wait to see?
Okay, there's no investing with that. It's metastatic liver cancer they're looking at. There's no investing. At this point, it is speculating. And I think that you can certainly speculate on any biotech that you want, but please just understand that you have to be able to lose a lot of money if you're going to make a lot of money. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
few things in this business are more satisfying than outfoxing the short sellers who bet against one of your favorite stocks that then romps higher, breaking free of the negative rap, shedding the shackles of poor performance. That's how I feel about Best Buy, the consumer electronics chain that reported much better than expected sales this morning, defying the predictions of those who called me a moron when we bought the stock for the Travel Trust. They said we were buying the next Circuit City, a flameout from yesteryear destroyed by Amazon. After this excellent quarter, I think it's all coming together for Best Buy because the quarter had what's known as better than expected cadence, keyword cadence, meaning sales improved into the end of the period. They even gave you a guide up because August, not including the quarter, was better than July. As CEO Corey Barry told us in a very confident conference call, quote, we delivered strong results in our domestic tablet and computing categories, end quote. Those two categories, by the way, put up 6% same-store sales growth, which bodes well for back-to-school season and the new AI-enabled PCs that will ship in volume this quarter. Going into the quarter, 6.5% of the float had been sold short, because the bears believed that Best Buy would lower estimates thanks to its extensive appliance exposure. But the good news in compute is that the computing part of the business trumped the softness in appliances, which have been such a drag. So the stock shot up 14%, and with a little momentum, I bet it can go still higher. We saw something last night. I don't know if you caught it. We had a great Max Levchin on the show, but we saw something even better from a firm. That's the Buy Now, Pay Later Kingpin, which reported a stunning number after the close. Now, Levchin, he talked last night and made it crystal clear that his Buy Now, Pay Later business is best in show. Now, the big worry here had been that the bigger arms business gets, and it is getting big, including a credit card, the dicier the loans would be. That turned out not to be the case. As Max said on the conference call, and I quote, in terms of credit, just a friendly reminder to everybody, these numbers are not an accident. We decide what we want to see, end quote. He went on to say, quote, what you see today are the numbers that we wanted to have, and we're happy with that, end quote. So much for the biggest risk bad loans theory. Next thing you know, this company will be wildly profitable. No wonder the stock soared an astounding 32% today. I think that it can still go higher. 10% of the float is short. That's way too much for companies growing this fast with really excellent risk control. Those people will be wrong. Finally, there's Crowdstrike, which we heard from earlier in the show. Back on July 19th, the cybersecurity company put out an update that caused possibly the largest IT outage in history, affecting millions of PCs worldwide. It was a major blow for a company that previously had a pristine reputation. So you might have thought that the outage would translate into a hideous quarter, right? Would customers really stick with Crowdstrike after such a massive fumble? But the quarter turned out to be excellent, with some huge contract wins, including a 9-figure deal. I think that CEO George Kurtz worked nonstop to ameliorate the damage, and it worked. Yes, I'll have to offer some concessions to get all the business he wants this year, but there were many people who told me that this company was kaput. Clearly, it's doing just fine. The resilience, the integrity, the quality products served Crowdstrike from an ignominious moment. Instead, they came as close as possible to turning lemons into lemonade from this disaster. No wonder the stock rallied nearly 3% and was up a lot more most of the day. For shareholders, none of these names were without risk. But what matters is the payoff was sweet, because the people running these companies are tireless and relentless in their drive for excellence, not to mention customer satisfaction. Successful businesses put customers first. When they do, you get these kinds of incredible gains, but only if you are willing to be a believer. I like to say that there's always a bull market somewhere. Probably start to find it just for you, right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.